and I also sit as an adjudicator. You might recognise my name and Walker Morris's name from the monthly legal updates that we produce for QSI. Hopefully you have found those helpful over the past few months, where we've tried to give a recap of all the key issues and happenings in construction law and related areas of law as well. But today I'm here to talk to you about retentions and late payment, in particular the Commercial Retentions Bill that is making its way through Parliament at the moment. It's currently in the House of Lords being debated, and you might think, well, it isn't law yet. It's just something that's going through, that you don't need to think about it yet. But actually, as I'll come on to later, this bill is going to become law. It's one of the Department for Business and Trade's key priorities in respect of the construction industry, and it is going to have wide-ranging impact both on the provisions and terms that can be included in construction contracts, and also day-to-day the mechanism for making payment and banking procedures. So I'm going to start and go through what the current problems are with retention and late payment. So why is this something that the government and the Department for Business and Trade think that actually needs addressing? What are the upcoming reforms and what might their commercial consequences be? And then I'm going to talk about some other options that might be implemented to protect the employer's position in given that cash retentions will no longer be allowed. Now, today I'm going to say the employer for ease, but what I say equally applies to a main contractor with regards to their supply chain. So anyone who is the paying party looking at protecting their position downstream. And similarly, I'll talk about what parties seeking payment might be able to do to help them secure that promptly and avoid delays and protect cash flow. So let's start off then with the key problems with retention. Now, as you'll all know, the common practice is to retain 3%, 5% of any payments due downstream until, for example, practical completion is achieved, and or then completion of making good of defects. The issue is that retention monies are not often kept in a separate pot and protected. The usual approach is that the paying party will just keep that money and use it to fund their day-to-day expenses just as part of any of their other monies. It is not this, separate retention that's in a box somewhere locked away. And that means that it can be dissipated and not be capable of recovery in the event of insolvency. But also, the majority of construction contracts are drafted so that the party seeking payment has to make an application for release of the retention. And there can be long arguments about whether all of the defects have been rectified, whether the retention is actually due for release. And we see in practice retentions being frequently withheld long after the defects liability period has expired. There's also the issue that, from the paying party's perspective, a cash retention isn't actually that good security because it grows as the value of the works grow. So if there are insolvency issues partway through a project, the retention is only going to be that 3%, 5% of the value of the works that have been carried out to date. And so actually isn't going to be enough money to complete the works. And so it could be argued, well, what is the point of this mechanism if it doesn't actually cover the risk that the paying party has of there being defects, there being insolvency? And the key point is that this delayed release or non-payment has a tangible impact on SME solvency, and the lack of cash flow creates difficulties. With regards to late payment, now this is something that the Department of Business and Trade has been focusing on for the past few years. The statistic that the Small Business Commissioner has published, is that there are at any one given time 26 billion in overdue invoices owed to UK small businesses. Now, that is a massive number, and it's obvious that that will create cash flow and insolvency difficulties. And, we only have to look at recent stories about the construction companies that have unfortunately entered insolvency. We've had Torsion just a few weeks ago. And you look at, well, what are the reasons why? And it comes down to cash flow issues on just one or two projects can really have a massive impact upon the financial viability of the business as a whole. And with late payment, as I've said, cash flow causes insolvencies. We also see this real trend of long payment terms being introduced. So, I frequently see in some large main contractors that their payment terms could be 60, 90 days or more from the due date, which again impacts cash flow. For a party that hasn't been paid, in reality, there are still limited options of what they can do to secure that payment quickly. You'll all know that there is, of course, the statutory right to suspend in the event of non-payment, but that requires there to be a notified sum that has been unpaid. And so it doesn't protect where there has been chronic undervaluation, for example, or where there has been lots of deductions made in a pay less notice that the other party doesn't agree with, but they can't suspend on that basis. There's also the point that in order to suspend, you have to give 7 days notice of that suspension. So there's going to be at least a week of delay in payment in any event. And that means that there's still these cash flow issues. And there's also the possibility of adjudication. But adjudication from start to finish, you can say takes 6-7 weeks by the time you prepared the papers and given the notice of intention to adjudicate. And the parties have to bear their own legal costs in the event of adjudication. And so it isn't something that is a quick way of actually getting the money. So, also, interest provisions are frequently amended or deleted. We see interest being reduced to 1%, 2%, and that means that there's not a sufficient stick to wave over paying parties to say to them, you need to make payment on time, or there's going to be interest because the interest rates are so low or don't apply. So they're the problems. What does the government propose to do about it? Well, we've got this commercial payments bill. It's also known as the Small Business Protections Bill. As I've said, currently in the House of Lords, making its way through the legislative process of Parliament. It was introduced to the House of Lords on the 19th of May, and then on the 21st of July, an amended version of the bill was published, which takes into account comments from the peers in the House of Lords of how they think the bill can be improved. It's expected to come into force in 2027. So we do have a few months to wait and to plan and prepare for what impact this might have. Key things that will be introduced by the bill are: 1, a ban on cash retentions. Any contractual provision which provides for monies to be withheld is now invalid. If they're included in contracts, they won't be valid anymore. That means that there just won't be a possibility of holding retentions. There's also a 60-day payment cap. So payment must be 60 days from the due date. This is reduced to 30 days for public authorities. There's also going to be a mandatory interest rate of 8% above the Bank of England base rate. So you're looking at interest rates of 11, 12% there.
CPD.
Already?
Yeah, they do this one. This is a...
Sorry there. Someone's got the mic on. If you could just switch that off, please. And excellent presentation. Thank you. Please continue.
Thank you. So look, there's going to be a mandatory interest rate, 8% above the Bank of England base rate. The idea is that that should be a deterrent to parties who might be thinking about paying late because the interest will quickly accrue. I'll come on to whether I think that will be effective or not, but that's the measure that's going to be introduced. Another key thing is that they're introducing a mandatory 7-day period for pay less notices. So it's common to amend construction contracts so that the deadline for a pay less notice can be as little as 1 day before the final date for payment. And paying parties look for that amendment because it gives them more time to consider the valuation, work out what sums they might be able to deduct from the valuation, and make sure that they have more time to not miss that deadline. This mandatory 7-day period shortens that time and therefore makes it more difficult for paying parties to make deductions and work out what the valuation position actually is. So a QS that's looking at doing a valuation is going to have to process those much more quickly, which will of course cause difficulties on large projects where there are multiple applications for payment in each payment cycle. An interesting point in that as well is that given that there's this 7-day period, there will need to be amendments to the standard form construction contracts because lots of them have, a period of 5 days before the final date for payment. There'll also be a penalty payment for unlawful retentions. So if, despite this bill saying that cash retentions are no longer allowed, a party decides, well, I'm going to hold a retention anyway, there will actually be an automatic penalty payable by that party. So if they try and withhold retention, that's going to be the sanction for it. Another point that I found interesting is that bank holidays will not count as extra days for payment. So if, as I've said, payment has to be 60 days from the due date. If there's a bank holiday between that period, it will still be 60 days. And where that might cause problems is if, for example, the deadline falls on a Monday, that Monday is a bank holiday, the payment is actually going to have to be due on that Friday. And so many large organizations won't be set up for that if their payments are automatically calculated on 60 days. And so there's going to have to be a bit of thinking about, well, is the banking system actually going to be able to comply with these payment terms? So if we're not going to have cash retentions anymore, what other options might there be for paying parties to protect their position? There's the option of a retention bond, but we haven't seen those typically taken up in the market because they are expensive. There's a fee for them, and that can be 1%, 2% of the actual contract sum. And so it can be very expensive. And there has to be a real concern about insolvency, about there being an issue of defects in order to justify the cost of that bond. And it's a similar thing with performance bonds. They are useful, but they are expensive. And so it's whether the risk is so great that it justifies that additional cost. You might be able to consider a parent company guarantee. They're typically provided free of charge. However, a parent company guarantee will only be available if the main contractor, the subcontractor, actually has a parent company. And even if you get a parent company guarantee, it's only going to be worth anything if that parent company actually has any assets. If it is just a shell company, then you're not going to get anything additional through having that parent company guarantee. So what can be actually in the contracts to help protect the paying party's position? And one thing that I envisage will be introduced is longer payment intervals. So there's nothing in this commercial payments bill, or indeed in the Construction Act, which requires payments to be made on a monthly basis. Of course, the common approach is monthly evaluations, but there's nothing that makes that mandatory. And so we could see construction contracts introducing valuations every 2 months, for example, so as to mean that the paying party can hold on to monies for longer. There may also be a switch to milestones so that payment is made upon completion of a particular element of the works, and a move away from this current most popular approach of monthly evaluations. QSs who are looking to protect a paying party's position will also need to look at robustly challenging valuations and making sure that there isn't any interim overpayment. So, for example, where you know that there is some money due for a particular element of works, but you don't have time to assess how much has actually been due. So you might think, well, I'll make a payment on account to them, and then we can work out the exact percentage of what's been done in the next valuation. But without the retention, that creates risk for the employer or for the paying party. Similarly, it's important to make deductions and contra charges as soon as there is the ability to do so. A common approach is to hold off from making deductions because you want to protect the commercial position with the contractor. You want to make sure that things are amicable and that the job is still progressing. You don't want to get too contractual. But by doing that, there's a risk that the paying party is going to overpay. They won't be able to recover those monies, and they will have no cushion of a cash retention. And on that note, it's important to avoid advance payments or payments on account, because again, it is just creating a risk of overpayment without a cushion there. But the thing with the bill, so I've talked about how, you know, it's not going to be welcomed by paying parties because they're going to have to look at other options. It will mean that they don't have this protection of the cash retention. But on the flip side, to be balanced, parties seeking payment could argue that the bill actually doesn't go far enough and that it isn't actually going to prevent late payment in the industry. And I say that because the final date for payment is linked to the due date. The provision in the bill is that the final date for payment has to be 60 days from the due date. There's nothing that prevents the due date itself from being extended. So a paying party who really wanted to hold on to money could say, look, there's a valuation date of the end of the month, and then the due date is however many days after that. And then the final date for payment has to be 60 days from the due date. So you could really extend the payment cycle, and there's nothing currently preventing that from happening. So it's that, you know, where there's a will, there's a way. If a paying party doesn't want to make payment, they'll find a way around this. I'd also argue that the interest provision isn't really effective because the fact that interest is accruing doesn't actually help cash flow at the time. And, you know, a party who is really struggling financially because they haven't been paid are still going to struggle, still going to potentially go into insolvency, even if they have an entitlement to a lot of interest. And from a paying party's perspective, the fact that if they don't pay for a few days, they're going to accrue interest might not actually matter if actually there's a wider business benefit to them of not making that payment, of being able to, you know, pay someone else where it's more pressing. And so the interest itself, I think, doesn't help either party. I mean, it's something that a party that has to suffer from late payment eventually gets paid. Great, you've got some interest as a compensation, but that only works if you manage to stay solvent during that period. The bill also doesn't introduce any new options for unpaid parties in construction contracts. So there's still the statutory right to suspend, but I've already talked about the limitations and problems with that. There's still the Construction Act adjudication scheme. The bill introduces a small business commissioner adjudication scheme, which is this procedure where the small business commissioner will be able to investigate issues of late payment and will be able to issue penalties and sanctions to particular parties. But importantly, that doesn't apply to construction contracts. The regime that will apply to construction contracts will be the existing Construction Act adjudication. So there's nothing new in there. So a party that is faced with non-payment still doesn't really have a lot that they can do to get that payment. I also think that there are a number of unintended consequences that could be introduced by this bill, which could create problems in the construction industry going forwards. One of which is that without the holding back of a cash retention, there may not be any incentive for contractors to actually return and rectify defects during the defects liability period, because there's no stick to wave over them in that respect. And so you're relying upon a contractor's concern about their reputation, their willingness to do a good job, which might not be something that happens in reality on every project. There's also likely to be delays in certifying practical completion because employers' agents, contract administrators are going to be looking for 100% defect-free works before practical completion is certified, because they're not going to want to make any final payments without knowing that everything has been rectified and that the snags have been reduced, because in order to protect the paying party's position, they'll want to make sure that there aren't going to be future issues. And that could actually mean that the main contractor, the subcontractor, is exposed to delay costs and liquidated damages because they haven't been able to secure certification of PC. You'll all have seen contractual provisions that provide that a particular sum can be withheld until a collateral warranty has been provided or until a performance bond parent company guarantee has been provided. Now, the wording that's currently in section 113A1 of the bill defines retention practices as the practice by which one party to a construction contract deducts or retains sums of money until any condition for release or partial release of the sums is met. That wording would extend to these provisions about collateral warranties and parent company guarantee, etc. So there will be no ability to withhold monies until those documents are provided. And that could make it more difficult in practice to then actually secure collateral warranties. And what I actually think will happen is that contracts will be amended so that the provision of a collateral warranty is actually a milestone that has a particular sum. It'll be a line item in a contract sum analysis, for example, and a particular sum won't actually become due and payable as a milestone until that warranty has been provided. So it's going to mean that, again, parties have to make changes, have to think of other ways in protecting their position. And I think all of this might create more tension during projects without that cushion of the cash retention that provides safety. Then there's going to be just a much more adversarial approach to valuations, to looking at sign off for practical completion. And ultimately, that could mean that projects aren't delivered as efficiently, as quickly, because parties won't be working together in the same way. So what should you be doing now to prepare for this? I think a good first step is to review the payment terms in your existing contracts that you deal with, any template precedent documents that you frequently use, and think about, well, do these comply? Is there something that we would need to change to make sure that when the bill does become law, we are ready and that we can be in line with this going forwards? I'd also look at banking procedures. So can payment actually be made within 60 days? And particularly that point I mentioned about bank holidays not counting and creating an extra day. So there may need to be a change in the approvals process that's adopted for payments, how payments are processed, so that these strict deadlines can be adhered to in time. It's worth also looking at any current tenders that you are either receiving or looking at putting in for 2027 to make sure that they take into account that there might not be any cash retention. And one thing that I think is really interesting is that the bill, when it was going through the House of Lords, the peers in the House of Lords suggested a lot of amendments that weren't actually accepted. So several Lords suggested that there should be things like AI tools to monitor payment practices, an open payment data register, a blockchain pilot for construction retention records, ESG reporting frameworks. And all of this was rejected by the Department of Business and Trade, the Small Business Commissioner. And they said, look, these are all great ideas, but we're not going to include this in the actual legislation itself. What we're going to do is we're going to get this legislation issued so that it becomes law, and we will then introduce a series of regulations and statutory instruments that will introduce all of these additional measures. So in practice, that means that we're going to get the bill next year. Changes will need to be made to construction contracts, to banking processes, and then we'll all need to keep a close eye on any regulations or other documents that are being issued. And there might need to be constant changes to documents to comply with them. So if, for example, a few months after the bill comes into law, there's a regulation which says, right, there's going to be this open payment data register, you'll need to introduce into contracts some sort of obligation to comply with that register. And so it's going to be one of those where you're going to have to pay attention to what's coming out and make sure that you're being nimble and adaptable and updating your contract documents to reflect the change in legal position. And on that point, Walker Morris, we are keeping an eye on things. We've already issued a number of articles that talk about this bill and what we think will happen, our tips for the future, and we will keep publishing updates as things progress. So please do keep an eye out for those. Please, if you're on LinkedIn, connect with me, and then you'll be able to see our articles and updates that we produce. And you can always contact me if you have any questions. And I can see that we have got a question in already, so let me just pull that up. So will the new bill affect existing contracts or new contracts only? It will affect existing contracts. There will be a transitional period. It's looking at the moment that the transitional period will be a period of 2 years, so that if there is a contract that is in place in 2027, that you'll be able to keep a cash retention for 2 years, which is fine if your program is pretty short, but if you're looking at a contract where it is a long build process, you might then be caught by the transitional period ending, and that will mean that even though your contract has those provisions, they're just as if they're not there, they're unenforceable, and you'll have to change the way. The bill is someone's asked, is the bill UK wide or England only? It is England, Wales and Scotland. It doesn't impact Northern Ireland, but it does affect England, Wales and Scotland. Does anyone have any other